This podcast is intended for investment professionals only.
Hello, and welcome to this final edition of Market Talk for 2023. In this episode, we'll be taking a quick look back at financial markets, but more importantly, we'll be looking ahead to 2024. We'll be asking, when will interest rates see their first cut in the new year, and what are the implications for asset classes? In a year where over 40% of the electorate go to the polls, how do US equities typically perform? After a disappointing 2023, both for its property sector and consumer, where next for China? And in the realms of unknown unknowns, what could be the black swan events for the upcoming year of the wood dragon? So, asking the questions for the final time this year is me, Francis Watson, here in the UK, and collecting his thoughts for the year ahead, Ben Bennett, who joins us from Hong Kong. Ben, hope you're well. A slightly different format today. And shall we kick off then with three things that we didn't see coming for 2023? Starting with the US recession. It failed to materialize. Why was that?
So far. Actually, we've got a few
So
more weeks
far.
left, so
Yeah,
who knows? No,
true.
but you're
Anything
right.
could happen.
You're right. Absolutely. No, you're right. It's been definitely stronger than expected, the US economy, but it's really been the only, there's lots of other economies that have been weak and even disappointed. I mean, Europe is stagnating. China's definitely disappointed. So it's not that everywhere has been stronger than expected. It really is a US peculiar thing. And a lot of that is to do with the fiscal support that's been put in place. So lots of various acts to promote investment, business investment, there's things to do with student loans, etc. We think that the fiscal support for the US was worth maybe 2.2% of GDP this year. So it increased GDP by 2.1% compared to what it would have been otherwise.
Yeah.
And if we project next year, we talk about the election in a second, so there's lots of uncertainties here, but we do think next year it'll be a small drag, maybe 0.3% negative. So the difference between those two numbers is 2.5%. So that could be enough to tip the US still into recession. That's still our call. That's still what I think, still what we think. The other parts that could still be positive for the US going forward could be the consumer keeps on spending money. They still had savings from COVID. Maybe they've got more savings. We don't know about that, and they could still spend it. And of course, the US could still do more fiscal support. So, there are still unknowns, but that would be our base case that the US will go into recession at some point next year. But they've done well so far.
And part of that fiscal largesse, if you like, Ben, we had the mini banking crisis, right, back in March. Everyone was sort of forecasting a little bit of Armageddon around that time, and that didn't happen either. Was that partly fiscal related?
It wasn't fiscal support there, but after when these banks got into trouble and there were all these long-dated assets that were on their balance sheet that they couldn't liquidate for fear of causing big holes in the balance sheet, the Fed did step in and allow some monetary support, some programs to be able to swap these assets. So it wasn't fiscal, it was monetary. And you're right, though, that could have been the crisis that potentially tipped over the US. So, the fiscal support at the same time helped stop that. But we have seen this year parts of the US economy squeezed by tighter financing conditions. And it's not just around the regional banking crisis, but more generally, if you have a short-dated liability, a loan, a small business loan, for example, that resets, with whatever base rates are, or credit cards, that move up and down with whatever is the rate, you are being squeezed. We are seeing credit card delinquencies go up. We are seeing small business loans go bad. But there are long-dated liabilities that are doing totally fine because companies and people with mortgages or companies with a long-dated bond, they're not refinancing. That's like a 10-year, 20-year, 30-year liability. So it has impacted parts of the economy badly, but the whole economy has got away with it so far. But if interest rates continue to remain high for a prolonged period of time, that will ultimately take down on all those other potential borrowers as well.
Yeah, I understand that. Yep, got it. We're being a bit US-centric, of course, because seems to me that 2023 has been the year of the Magnificent Seven, hasn't it? Why do you reckon some tech groups, though, have done better within that group than others?
Yeah, I mean that's definitely would have been a nice thing to have spoken about this time last year and informed everyone that the AI
We
is
don't
going to
give advice
explode.
though.
No,
That's our let out.
that's our excuse exactly. Well, that's right. No, I mean, obviously an amazing performance. Those 7 stocks are now. I think we discussed this last time we spoke. It's now 30% of the S&P
Yeah, we
500 in
did.
terms of
Yeah.
market cap. They are so big. I guess the question going forward for next year, and we can talk about that, is are they going to repeat that? Is there another 7 out there, another theme that could be positive? That's the key question, because it was pretty tricky to forecast that, this time last year, and it has just been eye-watering. Not just the US has done well this year; the European stocks have also done pretty well. But some of that was the relief that they didn't lose, run out of energy, run out of natural gas. Remember that was one of the
Yeah.
risks that we were talking about this time last year.
Yeah.
So there are a few equity markets that have done pretty well this year, but as you say, those 7 stocks have really been the standouts.
All right. Well, let's look ahead now then, and let's go from equities to bonds. I've been reading a few outlooks from the competition. Is that allowed? And the consensus seems to be that bonds are back for 2024. So, how do you see fixed income panning out for next year, Ben? And what about short term rates and quasi cash and all that jazz?
Yeah, I did my sort of what I thought yields could do for next year. I did it like in the middle of October, actually, so six weeks ago. And at the time, I thought there was it was almost a win-win for fixed income, because under a recession, yeah, sure, you're going to see some defaults potentially in credit markets, particularly high yield credit, but um, the government bond yield was high enough that was really giving you enough income to offset those defaults. So it felt, yeah, at the time, and I'm normally quite a downbeat, depressed sort of person, but even I was thinking that fixed income was looking quite good. But fast forward 6 weeks since I did that, and there's been a
Mm,
big rally in bonds. And I
mm,
actually just redid the numbers on Friday, a few days ago. And now, in a recession, if there's a recession, or if yields stay higher for longer and they squeeze markets, it's not quite so attractive, I think, for some of those sort of credit asset classes anymore. You almost do need to get the soft landing to get the returns that would give you enough to compensate, for moving out of cash, because cash still gets you sort of 4 or 5%, depending on where you put your cash. So I think right now the market investors are pricing in a soft landing, being and if you think there's going to be a soft landing, you will still, I think, get decent returns out of fixed income. So just go ahead. But if you're worried about recessions like I am, then it's a bit more of an even debate. I think that we'll see rate cuts next year, but that's because I think there's going to be a recession. I think under a soft landing, which is still, the economy weakening a little bit, under a soft landing, you're probably not going to get that many rate cuts, because you're coming in for a soft landing. You're not going to need to cut rates like in a recession. So that's why I think there's going to be rate cuts, but don't bank on them if you're in the soft landing camp, I'd say.
So just if you see total return then, from bonds, what you're saying, what I think you're saying is that you'll get the
Yeah.
income, okay, but it's that capital appreciation that could swing
Yeah.
either way still. Is that what you're saying?
That's right. And under a recession, I think that you could lose money from credit quality deterioration. So you get the income, absolutely, but then you'll lose money on your
Yeah.
bonds. In a recession, you normally do. That's all I'm saying. That you would normally lose on the credit side. So that's why it's not an obvious trade anymore. The income doesn't quite compensate you for the potential losses under recession right now.
Okay, understood. Now, inflation, of course, on a downward trend, and that's part of the reason, or one of the main reasons why the market is so euphoric at the moment. But it will we see a point where it will fall, but fall no more, and it's actually embedded all over the place?
Well, the caveat that I always say with this is that no one is any good at forecasting inflation, it seems to me. So that's so take
That's
everything
your
I say with
let
a pinch of
out.
salt.
Yeah,
Well, yeah, but I mean, even central bankers seem to be not very good at it. So yeah, who knows?
yeah.
But the common consensus and our view is that you are going to see sticky inflation still there if the unemployment situation remains tight. So if everyone's got a job and no one's losing their job, then why would you see inflation fall? Because everyone's going to want to have a pay rise. So you do need to land. And this is the interesting thing between a soft landing and hard landing. Soft landing is still growth having to slow down quite a lot from where it is today in the US and UK, everywhere. It will have to slow down to go below what potential growth is. And you're going to have to see unemployment go up a little bit. So I think even a soft landing, if we squeeze out inflation, soft landing won't feel brilliant. It will still feel like a deceleration. There'll still be pain. Some people will do better than others. And a hard landing where you get rid of the inflation properly, will feel like a proper recession. The higher for longer that we've had this year, that doesn't get rid of the inflation, I don't think, because it doesn't see unemployment going up enough.
Okay, interesting. So I want to turn now to elections. We said at the top, didn't we, that it's an enormous amount of elections going on next year, India, US, but of course a lot of people do focus on US elections. I actually looked up to see when the date was. It's November the 5th, which of course here in the UK is Fireworks Day.
Yeah, yeah.
I wonder if that's an FCW prediction for next year. I don't know. But tell us, Ben, because you've got that historic knowledge, tell us how asset classes typically do in a US election year, if you can.
Well, the uncertainty around any big events is always somewhat of a break. So up to an election year, you do tend to get that increase in volatility, uncertainty. But if we get a recession, that'll, I was going to say trump everything, but yeah, you've got to pick your words carefully on this year. So yeah, the recession would be the main thing. But on average, you'd say that there's higher uncertainty, and it's very tricky to call. So you're going to get a lot of uncertainty, a lot of swings around. I think if Trump gets back in, I remember sitting on the desk when he won the first time around, and everyone assumed that interest rates would fall. It would be a risk off. Everyone would be worried about what he might do going forward. It's a bit of an unknown quantity, and therefore people would want to buy government bonds and hide in safety. And actually, straight away, he came out with a speech and said, right, I'm going to unleash huge amounts of fiscal spending, and bonds sold off. So yields flew up and equities rallied, and he did lots of tax cuts. So it was totally the opposite of what we thought, but there was lots of volatility. I think that so let's just assume he does the same thing. If he gets in again, tax cuts potential, maybe you'd see higher yields under that basis. I think we know from the last time, geopolitically, lots of uncertainty. He wanted to pick a fight, but then do deals. So you get the bad, but then you get the potential that he wants to actually get something done. He doesn't just want to have a logjam or claim that there's deals. So that could be bad, then positive potentially. Biden, if Biden gets in, of course, we know what he's done over the last few. I mean, he's again been very clear, easing fiscal policy. The problem, if Biden gets in, there's a decent chance that the Republicans take the Senate this time around, because about a third of the Senate is up for grabs every 2 years. They get a six-year period in the Senate, and the third of the seats that are up for grabs this time around, there's 20 Democrat senators defending their seats and only 11 Republicans. So the Republicans, if they just take a couple of those Democrats, they could have the Senate, and then you'd have potentially a split government, and we know that just nothing happens, then, does it? So, and maybe that's good for markets if nothing happens.
Yeah. Now, of course, we haven't talked about China much, but it has been a miserable year for China, both in terms of equities and sentiment and all the rest of it, property especially. What are we expecting, Ben, going forward in 2024 there?
Yeah, so China's got like a double whammy. You've got the structural side, which we know is over-indebted, overbuilt, and that's going to take a few years to work out. And there is the risk of a financial issue, a big trust fund bank coming under pressure, and they're having to sort that out. So definitely don't discount that. There could still be some big flare-ups that we've seen in previous places where there's been too much debt. But there's also the cyclical side, and you tend to forget that as an analyst or strategist. Sometimes you just get depressed and see China just doing awfully for months and months and months. But at some point, businesses have cut their manufacturing so much that they don't have big inventories anymore. So at some point they have to restart production, and that means that the economy turns a little bit better. They've already fired the people they need to fire, and then but we need to start doing production, then we need to hire some people. So there is always a decent chance of a cyclical rebound. I haven't got any trigger for why that would happen next year, unfortunately. But you just got to bear that in mind. What goes down does sometimes go up, and China has been such a big underperformer. So for a prolonged period of time, it is relatively cheap on a cyclical basis. But bear in mind that super cycle, that debt super cycle, is hanging over it.
So some corporate lean machines there, though, amongst the indebted companies. Looking forward wouldn't be looking forward without asking you what your unknown unknowns are for the event, or AKA the black swan events.
Yeah.
We've had one or two recently. What's your feeling, Ben, geopolitically or otherwise there?
Yeah, I mean, I actually look. Our asset allocation team do a blog every year, and they call it grey swans because they say black swans are so unlikely. So I'm not totally sure about the colour of swans, but apparently they call it grey swans because that's slightly more likely. And I read what they had for last year. Lots of geopolitics. I think this is a time that we've got a lot of conflicts going on. But I mean, I don't see necessarily why one conflict leads to more conflicts. But yeah, that's you could see escalations around all that. Of course, I mean that's something that we worry about a lot. But I'd say beyond that, we spoke already about China financial deterioration. That if China needs to bail out a big bank, that could be something to look at. Same in the US. This is not necessarily just China here. If we get a recession in the US, then we've already seen with regional banks that can impact credit quality. So there could be more there, couldn't there? Again, this year we've seen Credit Suisse have to be in effect bought out by UBS. So even in a year where we haven't had a bad recession, things have looked pretty ropey. So I imagine that there could be more things associated with assets that have gone bad, either because of recession or because of yields go up. So those would be the things to look at again beyond the geopolitics.
Okay, interesting. Lifeboats at the ready. Now, from lifeboats at the ready to numbers of the ready, and I'm going to ask you for your number for 2024, Ben. You've got lots to choose from, I guess. What is it going to be and why?
Well, it's a sort of summary of what we've just been talking about in terms of China, what it might do next year, the Magnificent Seven. It's two numbers actually. It's plus 37 and minus 7. And those are the those are the returns. Plus 37 is up until Friday's close, the performance of the Nasdaq. So that's 37% higher on the year because of the Magnificent Seven and other things. And then minus 7% is the technology shares here in Hong Kong, the Hang Seng Tech, which is again a load of technology, which you'd have thought if the US technology is up 37, then perhaps the China technology is also up, but no, it's down 7. So the difference between the two is 45% or something. So it's not good enough. I guess this is me saying that this is quite tricky to give an outlook for next year. It's not good enough just to get the theme. You can't just say go and buy technology or AI, because you could have missed out by 40% if you got the wrong stock market within that. But so there's that difficulty there, but it's also just showing you the difference in valuation between those two markets. And going forward, I'd be surprised if we had another year that sort of discrepancy between the two. And as I said before, things that go down sometimes go up.
Yeah, there's been huge divergence, hasn't there? But luckily, no divergence in your commentary for the whole of the year, Ben, which has been superb as always. So really it leaves me to say thank you so much for all your insights for the year. I've really enjoyed listening to you. I know our listeners have too. And special thanks as well to our production team behind the scenes who keep us on the straight and narrow all year, to Josh, to Karen, to Liv. Thank you to you. But a big thanks, of course, always thank you to our listeners for keeping us on the road and listening to Ben's views. And we'll do it all again next year, starting with January, where we've got more market talk. We've also got more outlooks on the pod. So please do tune in for those when you've got time. Just from me to you, thank you. And Happy New Year when it comes. Thank you. As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of Legal and General Investment Management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licence Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.